Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In this video, we're going to take a deep dive at what's called the 60-40 portfolio. This is a portfolio that has served retirees in particular very well for a very, very long time, but it's come under fire lately. And many investment professionals are saying, look, the days of investing in a 60-40 portfolio in retirement are over. You need to make big, big changes. So that's what we're going to talk about today. Here's what we're going to do. We're going to first look generally at the 60-40 portfolio, sort of what it is. Then we're going to take a look at some of the concerns that folks have raised, why it may no longer be the best way to invest in retirement. Then I'm going to talk about why I actually think it still is pretty solid. I actually have a lot of confidence in the 60-40 portfolio. Not that it's the only way to invest in retirement, to be sure, but I'm actually still very confident, at least as confident as anyone can be, which maybe isn't very confident. But no, I still do believe the 60-40 portfolio is a sound way to invest in retirement. And then finally, we're going to look at possibly some tweaks we could make to it if we had certain concerns about the current economic environment. So that's what we're going to do. Let's get right to it. So number one, the 60-40 portfolio, very simple portfolio. When most people analyze it over decades and even more than a century, what they do is they look at typically an S&P 500 index fund for stocks. That represents 60% of the portfolio. And then for bonds, which are 40%, they would either be in like an intermediate term U.S. Treasury fund or perhaps a more broadly based U.S. bond fund, again, intermediate term, that might include some investment grade corporate bonds. You could think of a Vanguard total bond market fund. So that's it. It's a very simple portfolio, 60% in stocks, 40% in bonds. And how's it done? Well, we can go to the Vanguard page that we've looked at many times. Now, this goes back to 1926. And this is the 60-40 portfolio. It's averaged just over 9% return. And because there's 40% in bonds, its worst year, negative 26.6%, certainly not a fun time to be retired, but much better than, say, we dropped down to 100% stocks. It lost 43% that year. So this balanced fund, as it's often described, has done fairly well. Now, many of you point out in some of my past videos that, Rob, this data is great, but maybe it goes back too far. How relevant is 1926 and years following to, say, 2021? So I did the same analysis in Portfolio Visualizer. And what we looked at, I'm going to actually drop it back. We can go back to 1972 and analyze this portfolio. Again, we've got 60% in U.S. large cap stocks and 40% I used intermediate term treasuries. And we can see it's pretty much about the same compound annual growth rate. It's right here. It's actually a little higher when we look at 1972 to present day, 9.61%. And yeah, that's not a typo. Of course, this is over a 50-year time period. But look at this, the worst year, negative 16, call it 17%. Again, not a fun year, but much better than if we were 100% stocks, which we'll look at in a minute. And the max drawdown, this is probably 08 into 09, was a negative 28%. So it's still done really well. We could even look at a more current time period and drop this to, say, 1999, or maybe, well, we'll call it 99. Now, so I've put it right before the tech bubble crash. And then, of course, we have the Great Recession. So there's no doubt in my mind the returns will not be 9%, but let's see how it's done. Okay, just under 7%, still reasonably good given the events that we know that transpired. Its worst year, again, minus 16, minus 17%. So it's actually done extremely well over just about any time period. That's one of the reasons it's so popular. And we can actually compare it to a 100% stock portfolio, which of course we would expect to do better. And sure enough, it did. What's interesting about this, though, and one of the another reason the 60-40 portfolio is so popular, I'm going to actually pull it back to 1972 and take a look at the two portfolios. And I know these are big numbers. We're looking at 50 years. But really the key number is this compound annual growth rate. We can see 100% stock portfolio, obviously return more than the 60-40 portfolio. We would expect that. But look at the standard deviation, which is a measure of risk or volatility, significantly higher at 15.25% than the 60-40 portfolio at under 10%. And we can see that the worst year, more than twice the loss for the worst year of a 100% stock portfolio. The max drawdown, 51% versus 28%. And here's the other interesting thing. For very long periods of time, the 60-40 portfolio can do just as well as a 100% stock portfolio with less volatility. And you can see that here. In fact, we can go all the way out on this line to probably, 2011, maybe 2012. And these portfolios are neck and neck. That goes back to 1972. So we're talking a 40-year time period. The results are very, very close. Now, we know that since then, since 2012, there's been a big sort of bull run, particularly for large growth companies. And so we've seen the 100% stock portfolio pull ahead. But it would not at all surprise me if over the coming years, the 60-40 portfolio catches up. It would do that if stocks really fell, because a 100% stock portfolio would, of course, lose a lot more than a 60-40 portfolio. The real takeaway is 60-40 portfolio has done extremely well for a very, very long period of time. You get a lot of the growth that you would get even from a 100% stock portfolio, but about half the volatility, as we've seen, or not quite, but the volatility, the ups and downs are a lot less than a 100% stock portfolio. And so all that brings us to, well, then what's the problem? Why are folks saying that, the 60-40 portfolio is dead? Well, there's a number of reasons. I'm going to go over 4, and they're all very real, and I think a real concern for any investor, but particularly for those in retirement. The first is yields on bonds are, as we know, at all-time lows. I can show you as an example. This is a chart of the 10-year Treasury yield, and this chart goes back to 1962. And we can see it goes, the yield goes up and up and up until we get to the early 80s, and then it crashes down. And in fact, during the heart of the pandemic in 2020, it was at one point under 50 basis points, I believe. It went up to about 1.75% earlier this year. Now it's down, I want to say it's around, this chart shows it at 1.37. That's actually a little dated. I think it's actually a little lower even over the last few days. So yields are at a very low level. And so, of course, you're earning less interest. If we think about the 4% rule, which is, again, the idea that you can pull out 4% of your nest egg in year 1 of retirement and then adjust that for inflation going forward, that was first introduced by Bill Bingen, as we've talked about in the past, in a 1994 paper. He used historical data for the vast majority of his calculations, but he did need to look at some returns into the future. And obviously, you couldn't use actual data. He didn't have it, so he had to make some assumptions. And for bond returns, and he was using intermediate term treasuries, the same thing we're looking at on the screen right now, he assumed around 5%. Now, at the time, he published his paper in 94, that probably made sense. And we can look here in 94, yields were, it's 7%. He was probably using a more longer term average. And so it made a lot of sense for that assumption. But, what happens when you've got yields just over 1%? Retirees or anyone in bonds, you're not making a lot of interest. That's the first argument, and it's a very valid argument to make. It's sort of the reality we're in. The second argument against the 60-40 portfolio is related, and it's this idea that we had this, what they call a bull market. When you look at this chart, you think, well, how's that a bull market? Yields from 1982 or 81 have gone down, right? Yields go down when prices go up. And so prices on bonds have basically been going up for 40 years. And so the concern is, look, they've kind of hit rock bottom. Yes, we all know they could go lower. Heck, they could go negative. But I think the general view is we've kind of hit bottom. Inflation is a big concern. And we're going to start to see yields go up. And when that happens, if you watch my Bond Investing 101 video that I just released, you know that when prices or when yields or interest rates go up, the value of existing bonds go down. And in fact, I was looking at my intermediate term bond fund, and it's got capital losses this year as interest rates have ticked up a little bit. Now they've come back down, so we'll see what happens. But as they ticked up a little bit, there were actually losses in existing bonds. And so that's the second concern. We're getting low yields, and as interest rates rise, we'll get walloped again as the value of bonds go down. The third concern has to do with stocks. It's like, well, bonds are bad and stocks aren't any better. The concern is that the valuations are sky high, and surely we're going to have a significant a correction or bear market even in stocks. And we can look as an example of that at the Shiller PE. This is an adjusted PE that looks at sort of 10-year time periods, and this is a graph going back into the 1800s. You can see Black Tuesday, that's the 1929 stock market crash. The Shiller PE was at 30 at that point. Here we can see this was basically right before the tech bubble. It was at its highest, almost 45. Today, it's at 38, and that's extremely high, and it's been high for a while. Doesn't mean it's going to, stocks will fall tomorrow, but it does suggest that eventually we're going to have to see stocks go down significantly. And so that's sort of a third concern, is we could get walloped with bonds, and then we could get walloped with stocks. Of course, at that point, it's like, well, where's the safety? If stocks are a problem, bonds are a problem, what's left? We'll kind of come back to that in a minute. The fourth argument that I'll mention is sort of technical, I guess. This is from an article that I published, and actually I'll leave a link to it below the video, and it in turn links to all of the research that I'm showing you and talking about today. This came from a Bank of America research report published a couple of years ago, and it was looking at the correlation between stocks and bonds, and the idea of asset allocation and diversification is you want asset classes that are not highly correlated, meaning they don't move in lockstep with one another. You'd prefer that when one goes up, one goes down, or at least if one goes up, another one doesn't go up as much, or when it goes down, you have this diversity. And what this chart is showing us is that there was actually a good negative correlation between stocks and bonds over the last 20 years. That's what this part is right here. But the report was saying, look, that wasn't always the case. And if we look back in time, there was a long period of time when bonds and stocks moved together. And the report was the concern that we're heading back to this time period where bonds really won't hedge, if you will, the risks that stocks present to us. They won't hedge those risks very well. That was the concern. And in a nutshell, the four arguments I've walked through are the basic concerns with the 60/40 portfolio. Now, one might ask, okay, well, if that's true, if all those concerns are true and the 60/40 portfolio is problematic, what do we do? What's the alternative? And when you read the literature, for folks that are very critical of the 60/40 portfolio, honestly, they don't have any consistent alternative, to be honest with you. That's the bad news. The good news, though, is that notwithstanding all of those concerns, and they're valid for any investor, I actually am very bullish on the 60/40 portfolio, and I want to walk through 5 arguments as to why. All right, the first one is, as retirees, even if we retire at a traditional age of, say, 65, we are long-term investors. I mean, you can think of sort of a standard retirement planning period, 65 to 95. That's a 30-year time period. That's a very, very long time. And in fact, B of A did its own research and looked at some of the longevity, how long will we live? And what they came up with, and I'm reading from the report now, they said, look, if a 65-year-old couple retires, right, they have a 1 in 4 chance of at least one spouse living past age 97. That really surprised me. They actually have a 1 in 10 chance of at least one spouse living past 100. So even as retirees, we still have to remember, yes, we're spending money each year, but we are long-term investors. And I was thinking about, even a 35-year retirement period. To put that in perspective, 35 years ago, Ronald Reagan was president, and Boy George and Mr. T were filming an episode of the A-Team. Many of you probably have no idea what I'm talking about. The point is, we're long-term investors, even in retirement, and yes, We've got challenges now, and yes, maybe the stock market crashes and doesn't do well over the next few years, and maybe bond rates start to go up, and that's hurt existing bonds, but that's still a relatively short period of time. We need to think long term. I think that's very, very important. All right. The second thing, and what follows all relates to that long-term investing perspective. The 60-40 portfolio has worked since 1871. And what do I mean by that? So if we want to follow the 4% rule, that is, take out 4% of our portfolio in year one and then adjust those distributions for inflation over time, a 60-40 portfolio has survived for at least 30 years, regardless of whether you retired in 1871. I know I'm not making that number up. I'm going to show you in just a second. All the way through present day, at least as much data as we have, that 4% rule has worked. Let me show you another chart. This comes from Michael Kitz. This is a great chart. Again, links to this are in the article that I'll link to below the video. What this chart shows is what the initial withdrawal rates could have been, how much you could have taken out as a percentage of your portfolio in year one of retirement, and then adjusted that amount each year going forward, and still had your portfolio last at least 30 years. And again, he used a 60% stock, 40% bond portfolio. And these numbers may surprise you. You look at it and say, well, wait a minute, aren't all of these above 4%? In fact, some of them are above 10%. You're telling me that if I retired in, 1877, I could have taken out more than 10% of my portfolio in year one, adjusted the withdrawals for inflation thereafter, and it would have lasted 30 years? Yep, could have done it. And in fact, the worst case, typically it's 1966, which you see right here. Looks like 1930, that might be 1938, wasn't much better. Came out to 4.4%, which is consistent with, believe it or not, the 4% rule, because over time they've seen that it's really somewhere between 4 and 4.5%. But here's the point. The 60-40 portfolio has worked post-Civil War, if we want to go back that far. It worked through World War I. It worked through the stock market crash of 1929 and the Great Depression. It worked through World War II. It worked through double-digit inflation and interest rates that went in well into the double digits, mortgage rates of 15%, if you can believe it. And that brought us what we know of as stagflation, where we had stagnant growth and high inflation. Wasn't an easy time. In fact, that's what gives us this quote-unquote bad year of 1966. But it worked. It's even worked through modern times, including through the tech bubble, through 9/11, through the Great Recession, at least as far as we know. Of course, we haven't gone out 30 years yet. But when we look at past retirements through those difficult times, the 4% rule has consistently worked. Now, I'll be the first to admit that doesn't mean that it will work forever. I grant you that. And in fact, we could have some year in the future that's worse than 1966. But based on all of the data we have and all of the difficult times that have existed going all the way back to 1871, and it's consistently worked, not only actually at a 4% level, but at a 4.4% level, that gives me, a lot of confidence. Now, the third argument that I would make, and we've touched on it, is that the 60-40 portfolio is a great combination of growth and stability. And again, I want to go back to what we looked at a minute ago, where we compared it to the S&P 500 100% stock portfolio. Obviously, over time, the 100% stock portfolio is going to do better. But look at as we mentioned earlier, the max drawdown of the 60-40 portfolio is much, much lower than a 100% stock portfolio. The standard deviation, much lower than a 100% stock portfolio. The worst year, much lower by more than half than the worst year for all stock portfolio. And it managed that while still returning over this 50-year period more than 9.5%. That is an excellent track record, and I think it gives retirees the right mix of growth and stability, that we need. Now, it actually brings me to the fourth point, and that is that studies have shown that it's easier to stick with an investment plan when it's less volatile. In fact, Morningstar did a report. I'll show it to you. Again, it's linked to in the article. This is the report. And what they found was that trying to time the market actually cost investors on average 45 basis points. You can see that right here over a 10-year period. And what they found was that if the less volatile your investment or portfolio is, the more likely you're actually going to be able to stick to it. And that point, I think, is particularly important for retirees. I can speak from experience. When the only thing between you and the street is a nest egg, and maybe hopefully some Social Security, maybe other things, it takes on a whole different feeling. It can be frightening. And I think for most retirees, a 100% stock portfolio or even a 90-10 or 80-20 is probably going to be too volatile to handle emotionally. And it seems that the 60-40 portfolio is sort of that sweet spot between needing the growth and getting a lot of growth, but also having a much less volatile portfolio. So that's the fourth point. And the fifth and final argument, what gives me comfort in the 60-40 portfolio, is that we have seen how it does when rates go up and we have high inflation. Let me go back to a chart we looked at just a minute ago. It's this one. So this goes back to 1962. If we actually could go back to 1941, we would see that the 10-year yield at the start of that year was 1.95%. The only other time, except for current history, where it dipped below 2% at the start of the year. And of course, it slowly started to rise. We can see here from 1962 to 1982, the yield went from 4% to 14%, right? And we know, of course, at the same time, inflation went sky high, at least by US standards, double-digit inflation. Now, that's really, I think, the concern that most investors, and particularly retirees, have today. We're spending a lot of money. The country's going into a lot of debt. We've got very, very low interest rates. We've already seen signs of inflation. Is it temporary or not? That's the big debate. But those are serious issues and big concerns. And so I look back at the time period 62 to 82. Is it identical to our current situation? Of course not. There are a lot of differences. But it still represents a time where interest rates over that 20-year period rose by 10 points or more, depending on which interest rate you're looking at, and inflation went into double digits. And it raises the question, all right, well, how did the 60-40 portfolio survive that? Well, we already know the answer. We can even go back to the Kitz's article chart, and we can see it didn't matter. When you retired in those years, here's 1961, this goes to 1975, but we've seen it past that, even into the 80s, where the 60-40 portfolio still survived. Yes, it did represent difficult times, and you can see that here, where there was a number of retirement years where your initial withdrawal rate was much lower than, say, past time periods, right? But it was still at least 4.4%. The point is, the 60-40 portfolio survived that 20-year period from, say, the early 60s to the early 80s, where we saw increase in interest rates of 10 points or more and significant increases in inflation well into the double digits. So that gives me confidence that the 60-40 portfolio will survive what we're going through now. Again, it doesn't mean it's the only reasonable approach in retirement, that's for sure, but I actually think it's probably the starting point for most retirees. It's the sweet spot. Remember, Bill Bengen, when he did his research on the 4% rule, concluded that you want equity somewhere between 50 and 75%. And others that have done research since then basically confirm that result. There are some outliers, but more or less confirm that result. And the 60-40 portfolio is, I think, right in the sweet spot of that. So I'm still very confident of the 60-40 portfolio, at least as confident as I can be about investing in the future. Now, that still raises the question, though, should we make any changes to it? I mean, should we really just be 60% in an S&P 500 index fund and 40% in some sort of total bond fund or perhaps intermediate U.S. government treasury fund? Now, on that point, you'll see a lot of suggestions and a lot of recommendations. I will say that for my own personal portfolio, which is not a 60-40 portfolio at this point, but my situation I think is somewhat unique. But in any event, I have exposure to international stocks, including emerging markets. I also have money invested in US small cap companies. I have money invested in REITs as well. So I have diversified beyond just an S&P 500 index fund and intermediate term bonds. What I haven't done is added risk to my bond portfolio, which some suggest you should. Some suggest you should take on credit risk, which means investing in things like high yield corporate debt, otherwise known as junk bonds, or perhaps emerging market debt. I've been reluctant to do that. I see the bond and sort of fixed income portion of my portfolio as what gives the overall portfolio stability. And I just don't, when I think of emerging market debt and junk bonds, stability isn't the first thing that comes to mind, but I'll also be the first to recognize that those types of investments currently pay higher yields. I'm definitely earning very, very little on my fixed income portfolio right now. But that's been my approach to trying to balance this growth versus stability. Having said all of that, there's no guarantee. There's no guarantee that diversifying your portfolio will result, in a better outcome. And in fact, I can show you that briefly on the screen. Here we're looking at, the 60-40 portfolio versus US large cap. Let me jump back here for a second. Yeah, we'll actually use it here. We can actually change this. I've got other asset classes on the screen, as you can see. Let's make this, 25, and we'll put 25 in intermediate term treasuries, but let's put 10% in developed markets. Let's make this 20. We'll put 10% in emerging, 10% in REITs. I'm going to hold off on commodities for just a moment. We'll put, 10% in high yield and 5% in global bonds. So, oops, I've got too much. We're going to have to, let's make this 15. There we go. 25 in bonds plus 10 is 35 plus 5. Yeah, so this is a 60-40 portfolio, but significantly more diversified. When we analyze it, because of data limitations, it's looking at 1999 to 2021. And you can see the diversified portfolio has, in fact, slightly outperformed the standard 60-40 portfolio. You can see the compound annual growth rate is 7.45 versus 6.95. We do have to note, though, the worst year is 23% negative versus roughly 17. The max drawdown is higher. So we have added some volatility to the portfolio. The thing to keep in mind, though, is this goes from 1999. Let's change the date a little bit, and we'll say 2004. Now what happens? Well, now the standard 60-40 portfolio has actually outperformed the diversified portfolio, and it's done so with less risk, right? Now, what happened? Well, I moved us beyond the tech bubble burst. This is effectively the difference. But I did that to prove a point. Here, a more diversified portfolio, and yes, the results are very, very similar, but it actually underperformed the standard 60-40 portfolio, at least so far, from 2004 to today, 2021. So you're looking at about, 16, 17 years. The point is, I really believe in diversification. I'm much more comfortable having exposure at least to international equities and some small cap stocks and some REITs at a minimum. But I got to stress, that doesn't mean that portfolio will outperform a boring 60-40 S&P 500 intermediate term bond portfolio. I just am more comfortable not putting all of my eggs in just two baskets. I prefer maybe 5 or 6 baskets. That's my approach. Doesn't necessarily mean that it will perform better in the future. What I do believe, though, is that the 60-40 portfolio is as sound today as it's ever been. Does it mean we can't have some kind of future in which it doesn't survive a 30-year retirement using the 4% rule? Of course not. There's no way to know that in the future. But boy, it's survived some very ugly times in our world. And I suspect even if it were to underperform and not survive 30 years, it wouldn't be significant. But again, I can't tell the future. I do think it's a reasonable starting point, not the only approach to retirement investing, but I think a really good start for most investors. So there you go. If you have any questions, leave them in the comments below. I'll be happy to help you out as best I can. Remember, I'll leave a link to the article I published below the video that has links to all of the resources that I've mentioned. And until next time, remember, the best thing money can buy is financial freedom.